Daily Rates Live with the Mortgage Calculator. Thank you for tuning in. Today we're going to do some live rates here, and then we're going to go into the deep dive topic of fix and flip loans. Just give us a few minutes here to get started. Wait for us to go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. And as you tune in, feel free to drop a comment here. We did put the chat up on the screen. I see some comments were already coming in. Ashley, Michael, appreciate the comments. So as you pop in here, feel free to drop a comment as we wait to get started here. I hope everyone had a great weekend and is ready to get into this week. Looking forward to seeing what the rates are doing. Let's see here. Jason, thank you for the comment from LinkedIn. Appreciate it. We'll get started here in just a moment. Julio, Richard, thank you for the comments. We appreciate it. All right. So as we go through here, feel free to keep dropping comments and also ask any questions that you have, especially as we go through our deep dive topic. Bob, thank you for the comment. Melvin, Nicole, appreciate the comments. Keep dropping comments and any questions you have. And it looks like we are live on all the different platforms, so we can go ahead and get started. So we will take the chat off the screen, and then we can go ahead and get into it. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every morning on this show is go through the live rates for different mortgage programs and then do a deep dive into a different topic every day. Today's deep dive topic is something we're very familiar with here at the Mortgage Calculator, one of the types of loans that we specialize in, which is fix and flip loan. So our sales manager, Jose Gonzalez, with 28 years of experience as both a loan officer and a realtor, is going to go through a deep dive and go through some examples of fix and flip loans. But before we do that, just like we do every morning, Nick, let's go ahead up and pull up our pricing tool and see what the rates look like today. So if you're ready there, Nick, let's go ahead and check out the rates.
All right, let me switch my screen. Check it out. So as we do every day, we will set up a scenario here using our pricing tool. This is a tool for our team. We have over 300 licensed loan officers in 24 states for primary and second homes. And we can do our investor fix and flip, the SCR type loans, in 44 states. So this tool will show us the general rates and the APR for today, September 11th. It's just after 11 a.m. Eastern. So all our standard programs have new rates issued. Let me zoom in a touch on this. And this tool will show us the general rates and the APR, including all the fees. If you'd like a full breakdown of all the fees that go into the APR, an itemized loan estimate, please just get with one of our team members. So for all our demos today, we'll set up the same scenario as we do every day so we can compare APR across the programs. We'll set a $400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. We'll set the desired price to $99. That means we're going to ask the computer to find the best rate at one discount point in cost. And we'll compare our programs here. We'll start with conforming conventional as we do every day. Then we'll go into FHA, which is usually the second option for most borrowers. And then we'll check out expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs beyond the standard that you see here. We also offer VA and USDA. VA is only for our eligible vets and active service members. If you are eligible, let us know. We can quote it, no problem. And same with USDA, that's only for eligible properties. If you do happen to be shopping for one of those properties, let us know. We can quote it up, no problem. So we'll start with conforming conventional as we do every day. We'll do a purchase, 30-year fixed loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40%. So with these settings, as we do every morning, let's see where the rates are at. Woohoo! Going down. Great, right? So we love to see it go down. So this is lower than it was last week, which was a touch lower than it was the week before, which was the peak rates that we saw here. So today, best option, 7.25 rate, 0.875 discount points and costs, puts our final APR at 7.413. Last week we were at 7.5, and then the week before even a little higher at some point for the APR. So this is a great option for our customers that qualify for conventional. But if our customer has any trouble qualifying for conventional, typically the next option we look at, set up the same exact scenario, it's going to be FHA. FHA does allow a little more leniency on credit issues as well as a higher debt to income ratio. However, we'll keep everything exactly the same as our other demo so we can compare apples to apples between the conventional and the FHA. So I think FHA went down a touch as well. 6.5 rate, 0.875 discount points and cost, puts our final APR at 7.088. So notice the APR is actually a touch cheaper here for FHA in this exact example. So if our customer qualifies for both, they would probably pick an FHA loan, even though FHA does require upfront mortgage insurance and yearly mortgage insurance. It actually is a touch cheaper here with the APR. So a great option for our customers that can choose it, and our customers that must use it, obviously a welcome change there to the program. Now, where we really specialize is if our customer doesn't qualify for either of the standard programs. Many other banks or lenders may not have other options, but we specialize here at the Mortgage Calculator in expanded guidelines, also known as non-QM. So we have over 5,000 additional loan programs under this type where we can qualify our customers with alternative income. So we'll keep everything else the same, but notice a new option pops up now for income verification. So full doc is what we use for conventional and FHA. That means 2 years of tax returns, what most people are used to. So we'll typically choose this option to take advantage of one of these others, asset related or business bank statements. Our investor programs are just for investment properties. We'll talk about that in a minute. Personal bank statement 12-month is the most popular program. That's what we use for our demo. We also have RSU, stated, DOE, 1099, P&L, no income, CDFI, all kinds of different options. For the demo, though, the most popular one is the 12-month personal bank statement. And that's for our self-employed borrowers. Many times our self-employed borrowers, when they submit 2 years of tax returns, have various write-offs and may not qualify at all, or may just not quite have enough income to get them the home they really want when they use all of their write-offs for their tax returns. So we'll solve this problem for our borrower by using no tax returns at all. Simply use their last 12 bank statements and determine a debt-to-income ratio of 40% in this example, using just their cash in the bank. No tax returns involved at all. So many of our self-employed borrowers will qualify for double or triple the income using these methods. So let's check out our non-QM bank statement options this morning. The best option here at the top, 7.5 rate, 2 discount points in cost, puts our APR at 7.600. So remember conventional, 7.4 and some change there. Here we have a bank statement non-QM option. It's always going to be a little bit more expensive, but right now it's less than 0.2 more expensive for a bank statement option. So amazing right now where non-QM is almost identical to conventional. Definitely take advantage, especially for our borrowers that are on the edge there, may need a little extra help with the income. These programs are the solution for you. Now, notice we have hundreds of different options here as you scroll down. Some of these may have a little bit higher rates and costs. Some of these may allow bankruptcies, foreclosures, and other credit events, which would otherwise cause us to not qualify. So tons of different options here under non-QM. Please get with our team. They'll find which one of these hundreds of programs work best for you. And before I pass it over to Jose, every day we also want to do some example rates for investment properties. So we love to work with investors, whether they're first-time investors or seasoned. We have some great options. So we'll set up the same scenario, 80 LTV, 20% down payment, and we'll compare our investment property options. We'll compare our conventional programs with our non-QM expanded guideline options. Remember, government programs, FHA, VA, and USDA do not work for investments. So we'll simply compare these two. So we'll set conforming. Everything else will stay exactly the same as all our demos. All we've edited here is the occupancy. So now we can see what adjustments the conventional programs have added for investment properties. So the best option here at the top, 7.625 rate, 3.125 discount points in costs, puts our final APR at 7.863. So it's a good option for our customers that want to qualify full doc conventional. But most of our investors are asking for other options at higher rates. Most properties do cash flow usually a little bit higher rate to reduce these discount points. Most investors I would rather spend this $12,500 in this example on something else, another investment perhaps, and would typically like a higher rate with less discount points. Unfortunately, there are no options for conventional in this scenario, so that's where we present our final demo here for our investors, where we can solve that problem with our non-QM programs. So we'll set up the same scenario, 80 loan to value, 20% down payment, and we'll choose expanded guidelines, also known as non-QM. First thing we need to select is our income option, and the most popular income for investment properties is going to be our DSCR option. Because it doesn't require any income from our borrower or employment from our borrower, we simply use the estimated rental income from the property to determine a DSCR value. It stands for debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage we're proposing in this case, aka the property cash flows monthly, that's a ratio of 1.0 or higher. We even have options for properties that don't cash flow monthly, where the ratio may be under 1.00. For the demo, though, we always put 1.5, which is the highest value, so we can see all the options pop up. And the final thing is a prepayment penalty. 3 years is standard. That's what we always select. We can choose 0. That will cost more and limit the loan programs that pop up. And we can also choose 5 years, which will save our borrower some money in some cases, but not all the loan programs allow it, so they won't pop up. In order to show the most common options, we'll select 3 years as the standard. So with these settings, let's check out the DSCR rates this morning. Wow, almost beating conventional. We beat conventional a couple days over the last week as conventional was rising. Today, amazing option, 7.875, almost identical to conventional, but 0.975 discount points. So we solved our issue for our investors that want to spend a reasonable amount on discount points. Here is the option. And the final APR comes in at 7.941, just a touch above the conventional 7.8 and change. So amazing options here to use our DSCR. I'd say 90 to 100% of the investors that are presented with the conventional option we just presented with a DSCR option right here that's almost identical in cost and rate, we'll choose the DSCR option. So for all our investors out there, definitely check these out. There are a ton of different options as well. If you scroll down, there's some at higher rates and costs. Some of these may allow bankruptcies, foreclosures, other credit events that would otherwise cause us to not qualify. And some of these may allow short-term rental income, very popular request. And as a segue into our next topic, some of these programs may allow for low seasoning, which is the typical request for our topic today, are fix and flip investors. So DSCR is a popular request for people once they're done with the fix and flip, which we'll talk about tomorrow. Once they're done, how they hold the property long term. That's typically a DSCR loan. But today, we'll talk about getting into the fix and flip. So fix and flip, very popular request. Many investors want to purchase a property that may not otherwise qualify and include rehab funds in the loan. That's what a fix and flip is. It is a short-term loan. We're not talking about the 30-year loans we were just looking at. We're talking about usually 1 year short-term bridge loans that include rehab. So this is how we get into it. Tomorrow, our episode will be on fix and hold, where we'll talk about how to get into it and then how to get out of it, but still keep the property in their name. Today, we'll just be talking about the entrance part here, how to get into a fix and flip project. So you got some examples ready for us here today, Jose?
Yes, I do. So, first thing I wanted to clarify is that there are renovation loans, conventional renovation loans for investors, right? That is not what we're talking about here, because typically the conventional renovation loan will be for an investor that's going to buy a property that may need some renovation, but that is going to keep the property, right? So they're buying a property that may not have been able to close due to property related items, or that the investor simply wants to renovate, maybe put in new kitchen, bathrooms, windows, roofs, with the money from the loan, from the purchase loan. So it's a purchase loan and a renovation in one, but that is not what we're referring to when we're talking about our fix and flip loans. It is for the properties that are going to be repaired, rehabbed, and sold as part of the transaction without any worries about early payoff penalties. That is the big difference. The fixed flip loans are tailored for these types of transactions. That is why they are a bridge loan and not a fully amortizing 30-year loan. So these can be used for purchases, and they can also be used to refinance a property that was paid cash for the rehab portion, where the investor will recuperate some of the purchase funds and hopefully get 100% of the rehab covered by the new loan. So let me share some examples here with you. Our first example, and very important to note, there is a big difference between an experienced investor and an inexperienced investor. In some cases, it means not being able to do the deal unless you have some experience under your belt. So, what we usually recommend um, the fixed flipper to do in this scenario is to find a partner to do the deal as a joint venture so that you can use that partner's experience level. They do not go with the lower level of experience of the two, they go with the higher level of experience of the two. So you could have just one person as a borrower, but two people as the guarantor, for example, if you need to capitalize only on your joint venture partner's experience. But that's usually what we recommend in these cases because that will allow the flipper to get that experience under their belt that much quicker rather than try to find some alternative means to get that experience and possibly throw a wrench into their whole operation. So in this example here, I will show you what's on the bottom first so you can have an idea of what we're talking about. We have an ARV of $300,000. We have a rehab budget of $75,000, and we have a purchase price, which is also our as is value for this scenario of $150,000. So $150,000 purchase, 75,000 rehab, 300,000 ARV. Now, this is one of our fixed flip examples. We have many options for fixed flip loans, but this is one of our better examples. So here, due to our experienced flipper having 10 plus flips in the last 3 years, it's always in the last 3 years, they're lending us 85% of the current value as what they call the initial advance, right? So we have $150,000 purchase. So at closing, it's $127,500 loan, and then you see there's a $75,000 rehab budget, which is 100% funded. There is a cost of 3 points on this transaction. Excuse me, 4 points on this transaction, and our rate is 10. Here it is, right here, 10.24%. So very good rate for our very experienced flipper. They also happen to like the deal. They feel that there's enough meat on those bones to give that good rate. Keep in mind that there is an interest reserve that is built into this whole operation here, so you do not have to make any payments, right? So our interest reserve would be for either 6 months or 12 months. So in our next example here, you can see the difference from the 10 flip person, right, getting 85% to the one flip person getting 77.5%. They're still going to um, fund 100% of the rehab. They're just cutting back on the initial purchase LTV. Same transaction that we had, $300,000 ARV, $75,000 budget. And in this case, our rate is 10.99%. So they raised the rate about 0.75% and lowered our LTV on the to 77.5%. Now on the cash out refi, this is where they purchase the property cash and now they're trying to rehab the property and recuperate some of the monies that they paid up front. Same transaction, $150,000 as is, $150,000 purchase. But in this case, at closing, the advance is $90,000 with a $75,000 rehab budget, 100% financed. So they're financing 100% of the rehab and giving at closing 60% of the as is value. So you get 90,000 at closing, and then the 75,000 is paid in draws as it would be throughout the process. So pretty good deal. Paid 150. Now you're financing 165. Right. So pretty good. Again, based on an ARV after repaired value of $300,000. And they paid 150. They're going to put 75, so there'll be 225 plus closing costs. And here our rate is 10.74%. So very good rate. So on this product, you'll see now here in our last example, this product is not applicable, at least through this particular conduit, for an inexperienced flipper when it's a cash out. Right. So they want at least 3 transactions under your belt.
So you're saying there's no options for under 3 on this with
right.
this rate and term. Gotcha.
Correct. And and with this product. Exactly. So with this one, you need at least 3 flips to be able to do this, because it is as with a cash out, it is a higher risk transaction. So you're looking at 10.99 here. Right. They will fund 100% of the rehab, and they will also go up to the 60% loan to value, but only for our flipper with some experience. They don't want this to be a novice coming in and possibly not being able to complete the project, which is the big risk, is that the project isn't completed. You have a 75-80% completed home, and now you have to foreclose on it and somebody else has to finish it, which is a big risk.
All right, I don't see any questions. So I think we can go ahead and wrap it up then. Appreciate everybody tuning in. Remember, we do this show 11 a.m. Eastern every single weekday, where we go through the live rates and do a deep dive into a different topic. So we'll be right back here tomorrow with a new deep dive topic. If you want any more info on any of these programs, visit us at themortgagecalculator.com. Appreciate everybody tuning in, and we will see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.